Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today in the EIA show, we have a lot to cover. There was some good news, some interesting movements, just given the residual from Colonial. How is that being captured? And then what is that going to mean going forward when we start looking at, okay, we had some decent draws pretty much across the board when you look at storage, but then what does the demand look like? And then what is the response from the import side, which is going to be interesting to see when all of this lands and how it impacts things going forward. Then in the second part, we're going to go a bit deeper into what's happening with summer demand. How is that shaping up? Where do we expect things to go from here? And then when we turn to the last segment, we're going to look at exports and what is happening with Asia. We've seen another slowdown of vaccines getting rolled out, some shipments being canceled or cut into Latin America and Asia, which again is just going to limit some of the speed at which I think we get some normalcy in some of those regions. So we'll try to put it all together to understand kind of what is happening within the market. So, as a reminder, please like, share, subscribe. Our typical thing, just to remind you that your support is appreciated. So now we're just going to turn quickly to what is happening with the gasoline side, just to kind of follow on what we've seen with Colonial. So here we had a draw of 1.75 million from total storage, which takes us 7 million below that 5-year average. But we're going to talk about the 5-year average a bit more in terms of what is the relevancy to it. Is it something that should be looked at, but not married to, trying to understand the different impacts. And we're still getting some of this movement between storage in PADDIII and storage in PADDII. So when we look at PADDII, there was a small build of 340,000. In PADDIII, there was a fairly large draw of 2.26 million. Now, there's something to be considered as to where is this in transit and how is this being moved through the system, because it does take upwards to 15 days to get from the Gulf Coast into Linden, New Jersey, where this terminates, and trying to move some of this product back through the system. But the EIA is looking at something very specific, which is why it talks about product supplied, because it's looking at the supply to the end user, but not the end user itself. So it terminates after it goes from that, like as we keep saying, from the refiner to storage to pipes. And then once it gets to the blending area, the racks, and it goes to the consumer, that's where you start to see that disconnect. So when you look at what happened at the gas stations, when you had all of that pull forward of demand, you had that huge increase. That only pulled from one part of the section. So here we were expecting to see a fairly big drop in terms of demand, but instead we got one last push higher, which just means that we're going to get a bigger drop on the back end just because of where is this cutoff. And that's going to be something that we'll talk about in more detail in segment 2. One of the big ones here is gasoline, because here gasoline imports dropped 48,000 barrels a day, but when you look at the 5-year average, they were up 238,000, and coming into PADDII up 218,000. Now we're starting to see that creep up in PADDII, which saw 49,000 barrel a day increase, which is only 2,000 above the 5-year. But we're going to continue to see that increase. And the reason why we're going to see that, so just thinking about what is coming in this current segment, when we talk about it, 28 tankers are expected to arrive in the U.S. with about 1.1 million tons, mostly gasoline, in the week ending the 29th. So we're going to see another surge. So when we look at this right now, the numbers we're at about 1 million, 1.03 million coming into the U.S., and that's going to continue to backfill just because obviously it makes sense, just given the shortage that we had, the arbitrage that was open. But there's actually going to be more behind it because the ARB is still open. So this is what's going to hit today. But then when we look back across the Atlantic, there's going to be more to come down just given where the spreads are right now. So we will continue to see that movement. Now, even though the gasoline side saw a draw of 1.75, it's important to understand that blending components only saw a draw of 290,000. So this is where we continue to see, what are people focusing up by people? What are refiners focusing on? How are they trying to manage it? And then remember, you did get some of the EPA waivers. You're allowed to sell some of that residual winter grade. You didn't have to meet the same blending components. So this is going to remain in the system. So right now, that's only 3.5 million below the 5-year. And even with all of these movements, we're still seeing this fairly slow decline of gasoline just because refiners have maxed out gasoline production, and we do continue to see a big surge in residual imports. And just to look at that in a different way, here's where we look at PADDIII. So we're back into the top of the cloud. We're not at seasonally adjusted all-time highs, but we are at the highs for 2020, still at the relative highs for 2021 in PADDIII. And this is just to give a little bit more color on just product in general. So when we look at product, so European refined product exports to the U.S. are gonna increase again, just based on what we're seeing. So what have we seen so far? So we're going to get a jump in mostly gasoline and blending components to about 3.77 million tons in May, and obviously we're at May 26th. So there's going to be some residual that's also going to come in June, depending on when it gets off, when they're able to get to port and unloaded, which is coming from about 77 tankers, but there's 18 tankers that are already booked with about 785,000 tons. So when you consider where we sit right now, there's going to be a bigger residual coming through as we're already starting off June fairly strong. Now, the 3.77 million tons in May compares to 3.49 in April. So that's that walk up that we were talking about with that big residual. Now, diesel also had a big increase, and when you look at some of the management that they're trying to look at inventories as Europe takes in a fairly large shipment, I think it's about still at a 7-month high at what's coming through, but we'll talk about that again in a little bit. So they're actually exporting some diesel gas oil. So right now in May, we're going to import 605,000 tons versus 199,000 in April. So typically the U.S. ships distillate into Europe. Instead, we're actually having that flip, and it's coming into our market. So that's why we continue to see this fairly large move. Now, when we look at PADDIII, you can see that the drop has stopped. It's still at 2021 lows, off that little low here. But when you look at the builds that typically run into Memorial Day, which is coming up this Monday, and when we start talking about, okay, well, when was Memorial Day? When does this? So Memorial Day for 2019, when we start comparing it, was the 27th. So when we talk about that, we have to think about, okay, well, when we're comparing it to 2019, where was some of that residual? And then when we look at total gasoline inventories, we're still within the cloud for the 5 years, but obviously moving back towards the low for 2021. Now, when we talk about inventories and when we compare that with imports, we have to look at, okay, well, what is the pace of draws? Because comps are going to get harder and harder just because we normally get a drawdown during the summer months. Just obviously people are driving more, it's warmer out, there's places to go, people to see. So this is going to be that little bit of a residual shift. Now, when we look at U.S. oil, so before we go into just the total context of what is happening with totals, we want to look at U.S. oil and product total storage. So this is everything in the U.S. over the last 29 years. So this is kind of stacking things up to say, okay, well, where do we sit in total inventory? And when we look, the only time that it was higher was in 16, 17, and 2020. Everything else is well below, which is obviously why that we get this really low average over the last 29 years of 760 million. Where right now we're at 921 million. So, and you could see that it's drawing. I'm not saying it isn't, but it's still this fairly slow, just because we continue to be the dumping ground for a lot of the spare product that's out in the system. So every time we keep thinking that there's going to be less residual, that we're absorbing some of the spare capacity that's out there, we continue to see more that's sitting behind it, which again is becoming this mantra of, have we seen a permanent shift in trade routes? Are we starting to see this become more of a common a common factor, and that's something that we're going to tease out a bit more in the last segment. Then when we look at global, so let's go to all OECD crude oil and product inventories. So when we look at what is currently out there, so here is when we look at what is in the US on the OECD level, there's about 3 million, 3.01, just below that. It actually came up a little bit since the last report from IEA and OPEC. But according to the IEA and OPEC, including SPR, there's about 4.5 billion barrels in storage across the system. Now, that's not just crude, that's crude and products. And that doesn't include the rise in China and India, which obviously not OECD. So this is purely looking at OECD data. Now, when things that are normally quoted is that 2016 to 2020. So here, when you look at what is that the right number? Like, when do we say that spare capacity is now gone and we're at a better working point? Because when you look back to 2010 to 2014, which is this yellow line, which was about 2.65 billion. You have to consider that this is before OPEC broke apart or had their little fight coming into Thanksgiving of 2014. So this is when 2015 is when you saw that huge surge up, which is what you can see in the 2015 to 2019, or this gray bar, when you had that big shift in terms of almost 300 million barrels getting put additionally into storage. So should we have already drawn that down? Why are we keeping that in the system? Then you can turn to days to cover. Is that a better metric because there is more demand? But we're never going to go to zero like this. So this demand still, even though we have seen obviously rising demand over the last, essentially 10 years, moving up almost 1 million barrels a day every year for the last 10, the buffer, you could say, could grow, but does it have to grow by this much? And when do you start to see some of this pricing pressure? Because even through COVID, oil still moved. Oil was still moving throughout the system. So one of the most impactful supply chain disruptive things that we've hit in the last 50 some odd years, we never went to zero. So when you get these comments that we're we're drawing 670,000 or 500,000 excess, there's where supply is below demand. Well, there's still a lot of supply out there to meet that before we get into what you could say is more of a normalized number. So then when we look at what has happened in the curve, it's fairly stable from the previous week because we've been living in a fairly tight range, especially when you look at what has happened at the front end. The curve itself has remained fairly in line, so really not much to report home about. The biggest unknown is going to be what happens with Iran and the deal itself, because some are reporting that there's that they've started to store more crude on the water in order to the moment something is signed, something is that can push off and immediately take advantage. Now, what would the Iranian deal do? Obviously, the U.S. and Europe still wouldn't have the ability to buy quickly, but this would open up Asia to have another place to purchase, and India would be very excited for it. China, you would say they'd be excited for it, but by removing some of these additional headwinds and then increasing the amount of potential competition, China wouldn't really like it because it would now make the barrels more expensive, where China's already getting a great discount. So it would actually be to the benefit of Iran and less to China. But obviously it would also remove the hurdles of needing to do ship-to-ship transfers, putting a Malaysian flag on it, calling it Malaysian crude, and then moving it through. But these are some of those different components that we always talk about. Then when we look at COVID, so COVID continues to become less and less of an impact within the US and Europe, which is obviously a net positive, but it remains an overhang when we look at the Asia Pacific region. So when we look at India, it's at a positive trend. It's moving in the right direction in terms of India getting on the other side of a lot of these case increases, which is, again, what we normally see is case count go up, then hospitalizations, and then deaths. So here we're at the point where cases are starting to roll over. So hospitalizations could still stay elevated, and deaths are still going to grind higher when you look at just that natural trend. But it's moving in the right direction, which will allow some restart of some activity. Now, with the IOCs have already come out, India's already purchased 3 million barrels after taking a month hiatus, but the hope was for them to come back bigger, but instead they just put out another tender. It's still well below where the expectations were, and they've already have signaled that they're going to export additional diesel cargoes. Now, while that's happening, we turn to Malaysia, which is seeing an increase in cases. Japan and South Korea are fairly flattish. The problem is the speed in which they're getting vaccines and vaccinating remains very slow, which again is putting some of those headwinds on some of that activity in general. So then when we think about, okay, well, what is coming into the U.S. from Asia? May loading shipments of clean fuels from Asia to the Americas rose to 370,000 tons from 335,000 tons. And if you remember last week, we were saying that right now it looks like we're going to get back to about 410,000 tons coming from Asia into the U.S., which will just keep a steady flow coming realistically into PADDIII. That's going to be the end home for a lot of this product coming over from Asia. And that's something that we think is going to continue as we go, not just into from May, but some of that will obviously bleed into June, and then June is already going to start well above normal for the most part. So now when we look at the U.S. and come to what is happening in the U.S. right here, you can see that we had a draw of 1.66 million, taking us 17 million below the 5-year average. And then when we factor in the SPR, because we're continuing to sell down some of the SPR capacity, we had a draw of 3.31 million, just because, again, selling some of that product, using the proceeds to fix the system, upgrade some of the capacity. But now looking at what's happening within the commercial side, so PADDIII had an increase of 2.1 million, which they started to get some of those imports that we've been talking about. But PADDIII had a draw of 1.9, and some of that was, most of that was really driven by another increase in exports, but another decrease in imports. So the view was that we were going to see some of that flip, but instead we had that one last residual. Now we'll start to see some of that reverse. And we saw some of that adjust in PADDIII, which we'll talk about in a minute. And then Cushing drew by 1 million, coming down 9.3 below the 5-year average. But when we look at the spreads and you look at the physical market, the U.S. spreads on the physical side are fairly strong. So right now, when you look abroad, because you had India coming in to buy some U.S. crude, you had South Korea again, you had Europe. So that put a bid beneath some of the physical. And now that we're seeing some of that strength, we're seeing some softness on pricing coming out of West Africa. And even though Urals have traded a little better, we're still seeing some of this weakness that again is going to make the Urals a little bit better and Libya versus the US. So this is going to be some of that residual that we're going to look for. Now, just to give you an idea, the EIA Gibson shipbrokers are estimating that the Persian Gulf, Iran is holding about 69 million barrels at sea in the Persian Gulf. That seems high. I'm going to, obviously it's hard to tell what is being held, is it floating storage? Is it something where the tanker is empty and it's been empty? I haven't had a chance to go through and really look at what is available. We do know there's floating storage that would be made available and would just hit the market fairly quickly, that would saturate it in the near term. Now, when we look at land storage, stockpiles last week fell 4.3 million barrels to 658 million after stockpiles rose 7.8 the previous week. So we saw 7.8 go up, 4.3 come down when we look at land storage total. Now, when we look at west of Suez, so the U.S. obviously had a draw, but then the ARA actually had a build. So net, there's going to be a small draw, but again, we're still kind of going back and forth between Europe, U.S. in terms of what is seeing some of these drawdowns. And then when we look at east of Suez and go to the teapot side, Japan, we actually had another increase in storage. So this is tracking closer to 2020 versus trying to draw down closer to that 5-year average, which again is speaking to the problems that we continue to see on the COVID side and the demand side, which is offsetting. So here's when we start to look at floating storage. So it came down a bit as we had oil in transit coming off. So it's giving countries time to get stuff offshore and getting it into their back on shore. But then when we look at west of Suez, we're starting to see that increase again, which we'll talk about when we look at West Africa, and we're starting to see some buildup in the U.S. in the Gulf Coast, which is why I think you're going to see that flip in terms of U.S. exports. Not to say that they're going to go down by a lot. We still have that 2.6, 2.8. Given some of the recent purchases, it'll be closer to 2.8 than 2.6. Million barrels on the export side. But then when we look at imports, that's where we're going to start to see some of the residual coming in. And then when we look at east of Suez, we're still in this fairly tight band that continues to work through as COVID comes and goes. The restrictions come and go in terms of Asia, which is leaving some of that residual in the water. So then when we look at fuel demand recovery, here's where we're talking about where we had rest of Asia dropping down. That's where we continue to see those issues within India. Now you're starting to see it flatline a bit. We thought it was going to flatline a bit more. Instead, there was another leg down. And that's just because some of the other regions like Vietnam, Malaysia have gotten, Thailand and Taiwan have gotten a bit worse. And that's just putting a little bit of a pause. Now, North America has also gone fairly flat, which is something that we were expecting. Just because you had that pull through from Colonial, people pared back a bit. Now you'll start to see North America start to grind back up. And then Europe is getting back into this fairly comfortable range as the toll data gets a little bit better again. Now, Europe toll road gauge, which right now Italy was down 10.4% versus 12.7% a week ago. France was down 8%. Compared with 3.1% a week earlier. So that's actually a little bit worse. And again, that's why it's tough because you keep getting this movement. So as an average of the three, the weekly figure was down 6.3% compared with down 6.8%. So that's where we continue to see, again, just this flatlining. And then China is just going back and forth between these levels of, let's call it down 92% to 100%. And I think we're going to live within that range over the near term, especially when you look at just kind of where they sit on the average. Just in terms of rail and air, they're essentially back to not just 2019, but that's, I think the bigger side is where they were at the end of 2019 versus right now. They're back towards it's a little bit of the softer side, but again, back getting much closer to normal, if not too normal in general, when you look at the average through 17 and 19. Now, on the other side, that's where is demand going to go? We're seeing them import a bit more oil, not as much month over month, but year over year. But they did have new facilities come online. And so even though they're importing more oil, they're also exporting way more product. So that's why we always look at both sides of the equation. Then when we look at the U.S., this is what we've been talking about, and kind of things just going sideways. When we look at the commercial storage, we're not really moving in any real direction one way or the other. Clearly we're getting some small draws, but when we look at the 29-year average, this is when we start to see that acceleration as we go into Memorial Day weekend. So what should normally happen, and we'll talk about this a bit more in the next segment. So typically we get this big buildup ahead of Memorial Day. You get a lot of that product moving ahead of it, ahead of people filling up, people going away. And then you get this lull, and then you get some of that snapback. Now we'll talk about how does Colonial kind of shift some of that in the near term. Then when we look at PADDIII inventories, now we're below that 2020 high, but you can see that we're still sitting in this elevated level as they're trying to work through. So even though they should be importing more, they're going to try to work off of some of this excess inventory to try to get things a bit more normalized. Because when we talk about the 5-year average, PADDIII is still almost 16 million barrels over the 5-year average, and that's where we continue to see a lot of this glut. Now, when we turn to what is happening in Cushing is when we go over the last 15 years, this is where we typically start to see this drawdown, and the big pull from the export side was able to pull some of this down. But as some of those exports pare back a bit, not to say that we're still going to see draws out of Cushing, it's just the rate of change is going to be a bit more gradual. And that's when we start looking at imports on the crude side. So here you can see that we had imports drop by 138,000, and it was all driven really by PADDIII. So PADDIII had a drop of 534,000 barrels a day. So against the 5-year average, that's almost 1.75 million less than normal. While when we look at PADDIII had an increase of 465,000 barrels, which is 318,000 above the 5-year. So here's where we see this shift. So now this is what we were saying in terms of timing. We thought PADDIII numbers were going to start last week. Instead, they started more this week. And now we're going to see some of that flip. And now PADDIII is going to stay strong, is going to see an increase. PADDIII will still see more imports. It'll just be below what this week is. So we will see a net drop, but again, it'll still stay elevated versus the 5-year as PADDIII also sees that increase in activity. Then when we look at runs, so runs had an increase of 0.7%. So we went from 86.3% to 87%. That is a fairly high for what we were expecting. We were expecting 87% on the other side of Memorial Day. Instead, it essentially came just a week earlier, which is good in terms of pulling additional crude into the system. But again, when we go into the end of the year, into the beginning of summer, now maybe this was a pull forward and then we get a small drop as people, cut down a little bit as vacation time picks up. It's still 1.2% below the 5-year. But again, it's still moving much closer towards the average for this time of year. The question now becomes, do we get a big enough increase in demand to see a sustained move to the normal historics where we typically get to about 95, 97%? So then when we look at implied demand, so this is where things get a little crazy, because here we had an increase of gasoline by 255,000 barrels to 9.48 million barrels a day of implied demand. Now, distillate also had a big jump of 403,000, and then jet had a big increase of 213,000. Now, jet is still below the 5-year average, and we'll talk about that in a minute. But diesel still had that big pull through. We talked about this on the war when I filmed with Ryan Ray on the War Room, talking about how just there's a ton of trucking demand. There's still a lot of shortages in the supply chain. We're going to cover it again in the Econ show. We covered it last week in the Econ show. But now when we go forward, we want to talk about gasoline for a minute, because this is where we should have started to see that drop, where we had that big surge as the Colonial Pipeline came back. You started to see movements through the system. But instead of seeing this come lower, it had another step up, which I think speaks, at least in my opinion, to just how short or how much capacity was pulled forward, and how people were really panicking in not just some of the areas that were impacted, but even areas that were or really shouldn't have been impacted. And now so what does that mean going forward? Well, we'll most likely see a bigger move lower, because what we were expecting was about 8.2 million barrels a day, and instead it came in at about 9.4. So the assumption that we had was that we were going to get about 1 million barrels come out of the system and then get closer to that normal of 8.8, 8.9. Instead, we had that other 200. So now I still think we get to about 8.1, 8.2. It'll just be that bigger drop on the near term, while propane continues to be see a lot of strength in the system. So then when we look at floating storage, this is kind of what we were talking about. So we expected to see a spike up, but closer to where we were at the beginning of May. Instead, we've now gone through that number. And I think when you look at what's come through the number, not that we're going to get back to the 5-year average, but you can see the trend is typically up through June when you look at floating storage, because a lot of guys are preparing for that run up into summer. So we're not going to get the same type of run up. We still have a lot of crude in storage, specifically in PADDIII, which is where all of this would dump into. But it just shows that they're gearing up for a little bit of a push, which was going to be supportive of some of those runs, especially as we go through the remainder of the summer months. But even though we're getting more floating storage, you can see imports actually went down where we were expecting to see a little bit of a tick up. And just given where we are in floating storage and where we are in imports, it's clearly timing. So this is something that, you'll see this flip. This will just go back up, and if you look on a seasonal level, it typically spikes, but we just think it'll go back to those highs that we saw in April and then the beginning of May. Now, PADDIII had that small kind of counter-seasonal increase that we were talking about, and PADDIII is going to continue to see some of the support. It's always a matter of timing. So could it pull back? Yes. I just think that on average going forward, just given where runs are right now, we'll continue to maintain above the 5-year average and somewhere in between on an average basis through the kind of the middle, right between the middle of that cloud. And now just closing it off, when we look at percentage utilization, when we go over the last 15 years, you can see that on a rate of change level, we're just essentially matching where we should be right now. Typically at this point in time, we're at about 91%. We're currently at 87%. Obviously, there's still some of that residual slowdown, but that's where we continue to look as when are we going to start to close some of this gap and start to see a bit more come through. And that's something that we're going to talk about in segment 2 and then segment 3, because where are some of the differentials, where are some of the spreads, and where's that demand kind of going to shake out over the next few weeks.